And for those of you out there who are self-directed, who are trying to understand how do I evaluate stocks, ETFs, how do I understand investments and seek out opportunity, I think fundamental analysis is something that can be very useful for you. It can help you better understand risk, better understand some of the context of how a company works, how it maybe makes money, what are some unique risks to maybe that company, to that sector. And for those of you, again, who are trading, we want to hear from you. Maybe you'd like to use our Q&A or question and answer chat feature. Do you use fundamental analysis in your own approach, in your own process of evaluating investments, of evaluating trades? There are some out there that might use technical analysis where we look at charts and chart patterns, trends, things like that. There might be other purists out there that say, I don't do the charts. I want to understand the company. So again, good morning, good afternoon. Welcome, everyone. We're going to be talking about fundamental analysis. What we're going to do today is, again, we want to hear from you. Please feel free to share your thoughts, share your input, your experiences with fundamental analysis. Maybe there's some questions in terms of what's available on the website. What we're going to do today is we're going to use some slides that we've prepared. We've shared these a number of times, and we're going to talk about just general concepts about what fundamental analysis is. It's a very broad-based field of study, area of study. And then what we'll do is after we talk about kind of these kind of broad-based considerations, we're going to use some time to demonstrate some of the practical tools that you and I can use right on fidelity.com to help us understand things like financial statements, understand analyst ratings. I know, Nick, you'll want to cover at some point the equity summary score. And maybe we want to, again, understand some of these, fundamental statistics, whether it's PE, book value, price to book, et cetera, et cetera. So I'm excited. And Nick, I'm excited to be with you as well. Nick, of course, being a CFA, a chartered financial analyst. So good afternoon to you, Nick. I'm excited to start things off talking about fundamental analysis. Perhaps you'd like to start us off, share some of your thoughts, and what comes to your mind when we talk about fundamental analysis.
Absolutely, absolutely. Now, one thing I do want to let everyone know is that kind of learning fundamental analysis isn't something we can do in just an hour. It's not something we can do in just a week. And quite honestly, we could spend every day for the rest of the year and just scratch the surface. As Troy mentioned, I am a chartered financial analyst. I do have my CFA designation, and it took a solid 2 years straight of studying, um, passing 3 different tests in order to achieve that particular designation. My girlfriend at the time, now wife, she wouldn't see me because I'd get off of work at 4 o'clock from Active Trader Services from Strategy Desk, go across the street to the Starbucks. I would study until 10 p.m., 2 to 3 nights a week, typically 3 nights a week, and then I'd spend all day Saturday studying. And this went on for about 2 years. So there's a lot we can talk about, a lot we can cover. We're kind of scratching the tip of the iceberg, and really we're only talking about the really top part. You might put your flag up into, with that, not even just what's above the ocean, so to speak. That said, if you have any questions, if you have any comments, please send in those questions, send those comments to Troy and myself. For those that are interested in a recording, there is a recorded version that I hosted of a webinar about 2 or 3 months back or something like that. I can point everyone to where you can find that particular session. But that said, the recording's great to be able to, sit back, press pause, go refill your cup of coffee. I know when I was studying, I'd go through several of them in a particular study session, use the restroom, whatever you need to be, and come back and review and hit replay, so to speak. But that said, please send your questions, your comments, because it's the advantage of having a live session. Now, I want to talk a little bit about kind of the definition of fundamental analysis. Really, you're going to be looking at a company's books. And one big thing I want to mention that a lot of traders that get mixed up on is they might have 50 or 100 or 200 positions in their account. And I want to ask, can you really do your due diligence? Can you really dig through this information if you have 50 or 100 positions or more in your account. I know Warren Buffett, for example, talks about having 10 of his A list. 90% of his account is in his A list, then 10 of his B list. And having that last 10% of his account, and that's going to be his up and comers, his on deck securities. That said, because if you've done all the research, you've done all the digging, you like this, this one company, maybe you have like your top three. Is your top three going to be on the same level as maybe the 39th or 40th or 51st security you pick? Well, likely you've kind of scraped the bottom of the barrel and you're just add one in there to add one in there, and your 50th selection isn't going to be as good as your first selection. And so as such, I was talking with my mother over the weekend. She came down to visit me and was looking over her account and such. And one of the things I know she had position in Nvidia, like a lot of people might if you're tracking the market. And her position had done very, very well. But her position was only, it was a 0.5% of her account, so it didn't really impact much. Likewise, there are a couple positions that were down like 75%, but they're only a 0.5% of her accounts. They didn't really have any impact. So, for better or for worse, when you start to get too many choices, it's not beneficial. This is also building into that if you're doing your own analysis and such, a lot of these professional analysts, they'll look at 10 companies at once, and that's all they look at all quarter long and such. And they're going to be looking at these things. They're going to be looking at quality of management, labor relations, inventory control. Is there a trend in earnings, etc.? And likely they're all going to be like in the energy industry. So it's going to be, ExxonMobil, Chevron, Shell, BP, ConocoPhillips, Valero, etc. It's not going to be, Apple versus Goldman Sachs versus Exxon. It's going to be some similar companies and such. So that if they're looking at oil prices, it's going to impact all of them, so to speak. But you're not going to be looking at 15 or 20 different companies and such. And so it's important to kind of think about a lot of this. Now, what does quality of management mean? Why is this important? Well, think about Apple. Would Apple be the same company it is today without Steve Jobs' vision? Probably not. What about some other companies? I know you have some other, owner CEO companies, Meta Platforms, aka Facebook. You have, Tesla and such, where a lot of people invest in those companies because of the vision of the management. But who sits in that C-suite office isn't just what it's talking about with quality of management. It's also thinking about things like the board of directors. How diverse is the board of directors? And this has a lot of importance. Is the board of directors, are they elected to 3-year terms or elected to 1-year terms? It's easier to cycle out the bad directors. Likewise, is the entire board comprised of people that used to work for the company, have kind of worked their way up to become part of the board? Or are there some outsiders associated with that might bring in a fresh way of thinking? This can be important because if you take a company like Exxon, formerly one of the largest companies in the world, well, if you have everybody that's a former Exxon employee, well, they might just kind of keep drilling the way that they were always drilling. But what about if you brought in somebody from British Petroleum or ConocoPhillips, Royal Dutch Shell, one of these other companies on the board to maybe kind of provide some insight on like, hey, I know you guys have been doing it this way, but this is what we were doing, and we actually found better results this other method. Or maybe they might bring in somebody from Valero that's more refining based, that's more downstream versus upstream, etc. Or maybe they bring in somebody from Goldman Sachs that can provide some finance know-how. And maybe they can apply some, the ways that financial companies do things to an company, or maybe it's a tech company. That's where you get things like, fintech, financial tech and such that blend between finance and tech. Well, maybe there might be Finergy, where it's finance and energy, or Intertech, where it's energy and whatever it might be. But you need to have these other ways of doing things to impact. And that's where this quality of management comes into play. Labor relations, there a lot that can go into that. I know there was recently a threatened strike with flight attendants for a couple major carriers, and seen the impact of pilot strikes in Europe, more recently. And it's been a while since pilots have actually gone strike in the US, but that threat of strike, that relationship with labor is really important and such. Southwest Airlines used to be a great example of having an employee group that would go, 110%, 120% for the company because they knew the company had their back and would do the same thing for them. They had a great relationship with their labor. Inventory control. A lot of this might not seem glamorous, but it's actually really important. Inventory control. I always think about Dell computers. Before they then went private, now they're public again. In the heyday of the late 90s and early 2000s, they brought this new concept called just-in-time manufacturing that was really popular in Japan and such. And what it involved is, when they were building computers and they needed to, have a new computer chip, a new processor. Well, you buy a truckload of processors now and they're worth $150 now. Well, next month they're worth $75. The month after they're worth, $25. The month after you recycle them because the next one's out and such. And so, as such, what Dell would do is, as opposed to buying all the processors now and paying 150 and then maybe selling them for 150, maybe for 100 or 75 and such, we'd have the truck show up in the parking lot and walk out there and pull one off the truck, scan the barcode on it, and that's when it would come into the inventory system, and that's when they would pay for it. Hey, we need one. Go grab one. So if it's been sitting out there for a while, they're now with $100. Well, they'd pay $100 for it versus the 150 and so on. So things would arrive just in time. Now, this has caused problems recently with COVID and such, where beforehand, your Detroit manufacturers for autos would have a month's worth of tires or a week's worth of tires just sitting up in a warehouse. Well, now the tires show up at midnight for the cars that come off the assembly line in the morning, and they show up at noon for the cars that come off the assembly line in the afternoon and such. And if there's a delay in shipping, like the Evergreen incident that happened, in a very important shipping area that was then delaying ships by 6 weeks, well, all of a sudden you have cars that just sit there because they don't have tires. Or, lately with COVID, it's been computer chips. They didn't have the computer chips because those weren't being shipped because they were planning on them arriving just in time and they weren't arriving. So the inventory control can cause issues. We can go down the list of all these things and give really nice detailed examples, but it all comes back to that. This is what fundamental analysis is. It's looking at a company's books to come up with the value. Now, why are things like these ratios that we talk about, these other bullet points, why are they important? Well, with these ratios, this becomes important when you're comparing one company to another. Whether it's oil or not, I know Fred asked if we can compare Boeing to EADS. Not familiar with the symbol, but that might be like an Embraer or a Airbus or something like that, comparing one similar company to another similar company. That these ratios become important to kind of compare apples to apples. And for those that are wanting a copy of these slides, I can show everyone where the recorded version of the webinar we did is online, and it should have the slides there for you to download. Now, all these factors can impact different things, but as I said, it all comes back to being able to compare one company to another to make the decision that if you only have $10,000 and you're looking at it and going, well, you really need to have a $20,000 minimum investment per security, but you only got 10,000, so you got to pick one stock. You don't want to split it up into 2 or 3 different stocks. Well, which stock do you pick? You're looking at Boeing. Do you pick Boeing? Do you pick Embraer? Do you pick Airbus? Do you pick a technology company? What do you pick? Well, fundamental analysis can help you figure out which security looks best based on those numbers. Now, it kind of brings us to kind of the limits of fundamental analysis that it might show you what might be a good security, but it can't help you with timing. Is now a good time to buy? Is the market topped out? Are we about to crash? Fundamental analysis can't answer that question because fundamentally, this is fundamentally technically, on a like a technically correct kind of thing versus technical analysis, but fundamentally, technically, the market is a leading indicator of the economy. When the market drops, that's traders voting with their wallets. They expect the economy not to be doing so well. So you got to be mindful of it if you're looking at going, well, is the market going to drop or not? Well, the economy is not doing so well, so the market's going to drop. Well, the market is the leading indicator of the economy, not the economy being the indicator of the market, so to speak, with that. And so it becomes important that fundamental analysis can't really help you with the timing of the decision. Is now a good time? That's where technical analysis comes into play. Should I sell my security? How can I manage risk and such? That's really where technical analysis comes into play. Really, the best it can do is, if you've been analyzing Boeing and you like Boeing, but you don't like Airbus, now all of a sudden, well, you like Airbus prospects better than Boeing. Well, maybe based off of that, you go, okay, sell my Boeing and buy Airbus. But that's all you can really do is just to reallocate your capital based on that. It can't really help you on the timing, risk versus reward, etc. So much I just kind of addressed and talked about there. I know that it seemed like that there's just a couple small bullet points on the slides, but anything that you might want to add to that, Troy, before we kind of power on?
Yeah, before we move on, Nick, there's general concepts I think we want to keep in mind, right? So, with fundamental analysis, we're trying to understand the company itself more. And the company can sometimes be different than the stock, right? The company is the company itself, the stock is the stock's price, right? Whereas technical analysis, we're trying to understand the chart and we're trying to understand patterns. And so again, both goals, I think, of fundamental analysis and technical analysis are the same. It's the methods that are different. And, for me, in terms of just speaking anecdotally, I certainly welcome your thoughts as well, Nick. What's really been helpful for me in terms of fundamental analysis and why I use it when I'm, doing a lot of my research on single stocks is I kind of like to break it down. As you shared in that previous slide, Nick, there's so many different components to look at, and it can almost kind of give us this analysis paralysis where, okay, quality of management. Do I really need to research the board? Do I need to understand the CEO and where the CEO has been and understand the corporate C-suite, labor relations? Do I really got to read a ton of articles on labor relations? Do I need to understand macroeconomic factors? All of those are of importance. But I think that when you really try to boil it down, what are kind of the two major factors? And to me, it's really cost and value. That's really where what's kind of helped me is understanding, okay, what's been the performance and the growth of this company? How has the company actually done? And what has its performance been? And this is where what we're gonna get into when we look at financial statements, we look at some tools. We can look just like a chart looks backward in time. We can look backward in time in terms of a company's performance and understand how a company has done. And so the valuation or the cost, the company's performance, right? So it's performance growth versus what are you paying for that growth? And so it's this cost value dynamic is what am I paying for? How much do I need to pay? And then what am I getting? And I think, just to use again examples, everyone's situation is different and everyone's style and approach is differently. But just as an example, Warren Buffett is somebody, I know you mentioned Buffett, Nick, so just to stick with that theme, one of his quotes that it was either his or maybe it was Charlie Munger, actually, his colleague, who actually recently passed away. But for example, for Buffett and Berkshire, in terms of just anecdotally hearing Charlie and Warren talk about kind of their strategy and their approach, they would often mention that the value component is actually much more important to them than the cost component. And one famous quote they would always say is they would always say, I'd rather pay a fair price for a great company than a great price for a fair company. So the idea is, okay, we can be a bargain hunter, right? There's different styles and approaches to fundamental analysis. It's a whole area of study. So we can be a bargain hunter, but bargain hunter means, hey, I'm getting this stock potentially at a great price. It's really low right now. We want to try to, ideally buy low, sell high. We can also kind of momentum invest where we can see long-term trends and buy growth stocks and have them continue to go higher. But for people like Buffett and Charlie Munger, they would say, hey, we don't mind paying a little bit extra for a great company because if it really is a great company, it should continue to do well. It should continue to have earnings, cash flow to grow. It should have a solid moat, right? It should have a barrier to entry so that they can't suddenly be a new competitor, a new company that can enter the market and start taking market share away. So this idea is, we can try to have our cake and eat it too. We can try to find great companies and get a great price, but do we maybe want to focus more on one side or another where we look at, and again, we have to be careful about how do we define a great company and how do we define a great price? There can be companies that have a great performance, but sometimes the valuation is so high that the valuation comes down. And even with really good growth and performance, the stock price can actually go lower, even though the company does well. Conversely, there can actually be circumstances where, for example, the company performance hasn't been that great, but maybe the outlook changes, the expectation has been raised, and then that valuation goes up. So a stock can trade at a higher valuation than it suddenly did in the past for various factors. And even a company who hasn't performed well, its stock price can actually go up. So ideally, I think we want both. We want a company or a stock that does well, has positive results, and potentially we want expanding valuation to be both drivers of stock performance. But we can look at other factors. We need to understand how do we talk about a great company or a good company? And these are kind of subjective terms. So ideally, we want to quantify that a little bit further to really understand, again, a good company, a great company. What does that mean? And what might we look at? So, Nick, I'll definitely welcome some of your thoughts. Let me take a look at some of, again, the fundamental data that we look at. So we talked about the limitations of fundamental analysis in terms of timing, right? Again, if it's a great company, depending on how you define great, and we'll look at that, do you buy it now? Do you buy it next week? What if, even if it's a great company, what if the overall market's declining and there's a downtrend? Do you potentially wait till it stops trending lower? So again, if you could buy the same company, the same stock at a lower price next week, again, would you buy now? Fundamental analysis really doesn't help us with that. It doesn't really help us to take profits or really ideally to quantify risk reward versus, hey, I might trim my stock. If this happens, I might sell some here. We have to have some of those thoughts ourselves in addition to fundamentals. So let's take a look. Let's take a look. What kind of information do we have at our fingertips and what can we use when we're performing fundamental analysis? One of the main things is companies' financial statements. The three main financial statements are going to be a balance sheet, also sometimes referred to as a statement of financial position, an income statement. This is revenue, this has earnings, operating income. We also can look at things like cash flow. Where's the cash going? Is the cash coming in? Is the cash going out? How much cash do you have? What's been the change in your cash? There's been, again, with accounting, we usually look at things called, or a process called GAAP, which is generally accepted accounting principles. If it's an international company, it might use IFRS, International Financial Reporting Standards. But, with GAAP and with some of these, non-cash concepts like amortization, like depreciation, there's a lot of non-cash stuff that can happen. And sometimes there can be some finagling. So you might ask yourself, Troy, what do you look at, or what might somebody who does fundamental analysis look at? You're going to look at everything. You're going to look at top line, right? Where's the revenue? If a company's growing, we're going to look first of all at its revenue. You can't really fudge revenue because the idea is, okay, you had this many products or you performed this service, you did it this much. What's your total revenue? Where the fudging can kind of happen is sometimes in the middle and with bottom line stuff. There could be certain costs that can be written off. Maybe there's a one-time special tax event from the sale of long-term plant property and equipment that maybe is not going to happen every single year. So maybe you got a sudden write-off that really helped juice your bottom line earnings. A lot of companies will talk about that in their conference call. They'll say, hey, there was a big write-off, or we had a big lawsuit that just settled, where maybe there was the expectation that this could drag on and be a huge cost burden and liability for the company. And maybe we just settled it. And now all that liability is gone. The case is settled. No big deal, small cost. That can sometimes help a company's short-term performance as well. So revenue, that's the top line. Bottom line is earnings. And again, usually we're talking GAAP. There will be some companies that will use non-GAAP EPS, non-GAAP earnings per share. And then cash flow. Where's the cash going? Are you raising cash? Are you offering debt? Are you maybe doing secondary offerings of equity? Are you raising capital? Where do you see opportunity? What are you doing? Do you have a lot of cash? Nick, there's been times in history, companies like Apple, you mentioned Apple earlier, where Apple had a ton of cash and people were poking Apple, being like, Apple, what are you going to do with all that cash? You're just going to sit it on,
Yeah.
have it sit on your books? And are you going to make acquisitions? Like, do something? And so sometimes that can happen, or sometimes companies get strapped for cash where suddenly they've taken on short-term loans, they don't have a lot of cash, and sometimes there can be short-term liquidity concerns. Tesla, not too long ago, maybe it was about a year and a half, actually had some short-term funding concerns. And so again, this can happen. So this is company specific info. It's going to fall under financial statements, and there's a lot of information there. So this is a huge area of fundamental analysis. The second area is more macroeconomic. So this is not company specific, it's big picture information. Think about GDP, think about the idea of fiscal and monetary policy, unemployment, and other economic reports and surveys. There might be a jobs report. There might be a non-farm payrolls. You might see consumer confidence numbers, housing data, and that's going to kind of feed into what kind of an environment are we in? Is the consumer growing? Is the consumer tightening? And that's going to help you understand, okay, if I'm investing in a company that's very consumer driven, if we've seen a weakening consumer, might that be a lag on my company or that single stock that maybe you're looking at, or maybe that sector that you're looking at? There's certain cyclicality of certain sectors. And Fidelity, we'll call this the business cycle. And there's a whole, tidbit available on fidelity.com that can help us understand the business cycle. So let's take a look at some of this information, and then we'll dive deeper into the specifics in terms of tools on fidelity.com. So Nick, why don't you chime in here, share some of your thoughts, and let's talk about some financial statements.
Absolutely, absolutely. And something I do want to bring up as we talk about some of that macroeconomic stuff is there is a little bit of a difference between top down and bottom up. Top down is taking a look at that macroeconomic data, or bottom up is looking at a company's balance sheet, income statements, cash flow, in essence, what they report on a quarterly basis as they're required to by the SEC. And such with this, when it comes to some of the top down analysis, when you have a company like Microsoft, Nvidia, Apple, $3 trillion companies, how fast can they actually grow? Well, Nvidia's grown quite quickly, and you can easily grow from a $30 billion company to a $300 billion company. And actually grow from a $300 billion company to a $3 trillion company at a pretty good clip. What about from a $3 trillion company to a $30 trillion company? Well, at that size, they're actually larger than US GDP. US GDP is just under $25 trillion right now. World GDP is right about $100 trillion. And so as such, when companies get to be really large like that, many analysts will say, okay, well, we see growth at GDP plus 2%, GDP plus 4%, as opposed to, a 12% or 20% growth. They can't keep growing like this. Now, a company like Nvidia might have its valuations so high because starting to get into some of those multiples that it's priced because they expect earnings to come up eventually to meet the price and such. But that's a little bit of difference between growth versus value, top down versus bottom up. Now, I do want to shift forward a little bit and start to talk about some of these different companies. And as such, if anybody does have some particular example securities they'd like for us to use, we're happy to dig into and utilize these particular examples. I know Boeing was mentioned earlier. We can continue to use Boeing, of course. So let me just pull this up real quick, and I'll share the stock research center part. But while I do that, I want to just kind of let these slides sit out here. This first part is a balance sheet, and it's showing, what the assets and liabilities are of a company. It goes back to that the old accounting term, assets equal liabilities plus shareholders' equity. What happens when your liabilities are more than your assets? Well, there's not any equity in the company. And you can kind of think about this from a really cut and dry standpoint, that if everything the company has was liquidated and it paid off all the debts, would there be anything left over? Now, this is ignoring things like that they might value, building it, $100 million. And it's worth $100 million, but they had to sell it right now. They'd only get like 50 for it because of that rush to liquidate, so to speak. Being foreclosed on. So there might be some differences there. If it actually comes down to it and the company is closed down. But we have this accounting term: assets equal liabilities plus shareholders' equity. So there's different types of assets that a company might have. What about name recognition? Think about a company like Radio Shack. Has very wide name recognition, even if the company isn't worth anything anymore. Another one that was similar that went bankrupt, Bed Bath and Beyond. And as such, there might not be any physical stores anymore. But when the company closed down and auctioned off the assets, well, the name Bed Bath and Beyond was one of the things that was then sold, and another website bought it to still sell things online under the Bed Bath and Beyond name because that was worth something, even though it's not something physical with that. And so there's a lot of this that could be, tangible assets, non-tangible assets, and so on with this, just with even, as I said, name recognition. Now let me shift back over here to, this is the Stock Research Center. And, there are, a couple different places you can find a lot of the information we're going to look at. We're going to start over here on the statistics side. You do have key statistics here, but we're going to come down over here to the financial statements, where we can actually see the balance sheet. Now, a lot of this has been streamlined. Data is standardized by S&P Capital, and we'll talk a little bit about that. But the income statement has some great examples of how this has been streamlined. But this will then show some of those current assets, non-current assets, current liabilities, non-current liabilities, and so on. One thing I do want to mention, when it comes to those assets and liabilities, current is anything coming up in the next 12 months. Non-current is beyond. So let's say you're leasing a building, and you're leasing a building for $1.2 million over 10 years. I'm trying to use round numbers on this because $1.2 million is $120,000 a year, is $10,000 a month. So as such, of that $1.2 million, $120,000 is a current liability, and all the rest is a non-current liability because it's due years 2 to 10 on there versus now. Things like, from a personal basis, credit card debt. It's going to be current because it's kind of due now, so to speak. Where if took out a mortgage to buy a home, or you took out a loan to buy a car, a large portion of that will be non-current. Only your payments due in the next 12 months will be considered to be current. Likewise, you have current and non-current assets and such. And different assets are broken down to different things, like cash or cash-like instruments. If you're Boeing and you have a bunch of airplanes and such, well, the airplanes you have going through your manufacturing line, they're an asset. But if you're not going to deliver it for 2 years, well, that's going to be something a little bit more difficult, so to speak, on that. And compare that asset to maybe they had some extra cash and they bought some treasuries and such. Well, that asset they can liquidate and have cash to make payroll right now. Where a plane that's sitting out it's going to have to go through testing that's going to be delivered in 18 months, they can't really make payroll on that now. Well, maybe they can still put it up and collateralize and borrow against it, but there's some differences there between being a current asset that's very, very liquid, being kind of cash, you have cash and short-term investments and such, versus some of those non-current assets. Receivables might be if you sold something and you've given them terms. They have to pay you in the next 30 days, 60 days, 90 days, and such. I remember working for a home builder. We'd buy a whole bunch of lumber, lots and lots of lumber, $100,000 worth of lumber in a month, very, very easily. And we didn't have to buy it. We didn't have to pay for it when it showed up. Well, we had 30 days to pay for it, kind of like a credit card. And sometimes if you paid it off a little bit early, you get a discount. And if you took you 60 days, they charge a little more interest on it. And so this all considered to be short term on that, but those are receivables. The same thing, that would be a receivable for the lumber yard, but it would be a payable current liabilities that payable from the perspective of the builder or the company, so to speak, with that. So you have those current assets, those non-current assets, intangibles like what's your name worth and such, and then liabilities, debt and current liabilities, accounts payable. In addition to taxes owed, some other current liabilities, long-term liabilities, that long-term portion of the debt, other things going out there. And then of course we have shareholders' equity is whatever might be left over. Now, some of these can then be shifted over into different ratios and such. The debt to equity, assets, turnovers, and such. And kind of been talking about some of those very specifics on those cash-like assets versus not, because some institutions will take a look at those liquid assets, cash and cash equivalents, marketable securities, accounts receivable, stuff that's very, very liquid and such, and take a look at its current liabilities. Because if, depending on these ratios, if you have a lot of current assets, if you're Apple with $200 billion of cash on the books, and Apple were to come and say, with $200 billion of cash on the books, like they were several years back, and say, we want to borrow $1 billion. A lot of banks would have been, sure, we'll lend you $1 billion and we'll give you a fantastic interest rate on it because you don't need the money. You have $200 billion of cash sitting on your books. But the flip side of, you have a company that's struggling, can't make payroll, has very, very little cash, and they have $1 million in their bank account. Like, hey, can we borrow $1 billion? And the bank's like, we'll lend you $1 million. Kind of coming back to some of these ratios and such. How likely is it that they're going to pay that back? And some of this can be applied on that personal level of, if you've, for those in the audience that have gone through the process of, buying a house or buying a car, they take a look at your debt to income. What's your monthly expenses? It's your kind of your liabilities. How much are you paying each month versus what's your monthly income? How much do you bring in each month? That's your accounts receivable, so to speak. And they take a look at, well, do you have enough of a coverage ratio? Is it likely that you're going to be able to make those payments? Well, that's why some of these numbers are important. Can they make those payments and such? Or can they make payroll? The debt to equity and such. And this kind of comes into some, ratios, some corporate structuring. If you have a company that has no debt, is that good or is that bad? Well, a lot of investors would argue that's not a good thing. That was the case like with Apple. Apple was a $800 billion company with $200 billion on the books that was just doing nothing. That investors were saying, "Hey, give us that money, we'll put it to work somewhere else." Because then it kind of comes to stand by that Apple can only grow so fast, company can only grow so fast that maybe if you have a growth rate of 10%, well, if you can borrow money at 5% and then double your growth, then you're growing at 20%, you sacrifice 5 of it to cover your debt, well, you're then able to return 15% growth to your shareholders versus 10% growth. And so leverage can be a good thing. And so companies that aren't taking advantage of debt, that can be as bad as companies that have too much debt. So different industries have different ratios and such to compare with. Utility companies tend to have a lot higher debt and such because they have a lot of capital investment they have to make in their power plants, their underground cables, or whatever their infrastructure might be. Where a pharmaceutical company might have a lot less debt and they burned through a bunch of cash doing research and such. Same thing with technology companies. With this, so there's so much we can talk about, and we only have about another 15, 20 minutes of time left. Anything you might want to add to this balance sheet conversation before we take a look at the income statement, Troy?
No, I think that just about does it, Nick. Again, it's a snapshot in time. It's how is this company structured? What does its capital structure look like? Does it have a lot of debt? Does it have a lot of equity? You see some of the ratios here. Quick ratio, looking at more liquid current assets versus current liabilities, total assets, total liabilities. So again, this is a statement in time. You can also look at how has a company's capital structure changed over time. Have their assets grown? Have their assets been stable or flat? Has their debt grown? You mentioned companies can get into financial trouble. Sometimes they can start to borrow and borrow, and things are not paying off, and they get more and more indebted. And sometimes, if their assets are staying flat or going down, the debt can sometimes grow. So we can see how a capital structure changes over time. The next thing in terms of financial statements is the income and the statement of cash flow. I know we have a
Hmm.
limited amount of time, Nick, so why don't we cover these? And then I think there's a couple tools maybe we want to take a look at in terms of, I know you mentioned the equity summary score. There's a stock screener tool. We can screen for a lot of metrics. There's really so much to look at.
So with this, I pulled up, I'm showing the income statement, and there are a couple things I'd like to show, I'd like to demonstrate for everyone when it comes to these things. So this kind of starts top of line. What's the company's revenue? And this is this sales turnover net is what this revenue is showing. If we come back over here to Boeing, we'll just click on income statement, we can see sales turnover net. And then there's a cost of goods sold. So this kind of then takes us to our net profit. You have what they sold, what it cost them to sell, that gross profit. And of course, different companies they work a little bit differently because you'll have some companies and such that might be service oriented. Fidelity is kind of a service company. A CPA firm would be a service company. Well, their kind of cost of goods sold is going to be kind of their employees and such. Or a technology company, it's their coders, they're designers and such. And so they might have different margins and such compared to, let's say, a grocery store that buys a can of beans for $1 and sells it for $1 too, where their cost of goods sold might be a lot different, a lot higher in comparison. So uh, this is all standardized on here, and so it's a little bit different, and different companies will break different things down, but kind of in the basics here, you have sales, cost of goods sold. Here's your gross profit. Then you got to pull out some of those other selling, general, administrative expenses and such, which again, different companies will be different things, but some of this can then be that you might have, if it's a grocery store, yes, the goods cost something, but now you then have to cover, well, the rent for the store, rent for the store manager and such, keeping the lights on, some of those other general expenses that you're going to incur, even if you don't sell anything on here. This is going to kind of give you your operating income, your OI. And then we're going to add in there depreciation, amortization, and such. And so you can kind of think of, those you might have heard, the terms EBIT, EBITDA, earnings before interest and taxes, earnings before interest and taxes, depreciation, amortization. So this is kind of your EBITDA here, because this is before depreciation, amortization, and such. So OI, EBITDA on here. Then after depreciation and amortization, here's your operating income after, your EBIT, because it's before interest and taxes and such. And then you're going to have your other than your net operating, you're going to have your net income down here after all those expenses are taken out. Now, this could be in, this is MM on here. And so we're looking at, millions of dollars on here versus it just being handfuls of dollars. But as such, this is then divided by the number of shares that have a relative basis. You see total what a company makes or loses, and then it's shifted over to see, what they made or lost per share and such with that. So I want to kind of then compare something else real quick and kind of show what that standardization means. And to kind of show that standardization, I pulled up two kind of similar companies, two competitive companies, Walmart and Costco. Sam's Club and Costco on here. And then what I've also done is I've scrolled down and we've come down to these SEC filings. They're quarterly reports. A lot of them were just filed recently. So we have the 10K. We're kicking this up here. Here's the 10K for Walmart. We'll pull this up. Here's the 10K, the 10Q, I'm sorry, for Costco. We'll pull this up. And this will have the exact information we've been talking about, to an extent, line by line, the balance sheet and such. Have an income statement and such on here. As we scroll down a little bit to find that, normally they're at the very top. But with the balance sheet, you'll then be able to see, we'll jump down here to the financial statement, that Costco has net sales and membership fees. It breaks it down. And what I was wanting to show everyone is, when it comes to Walmart doesn't break down that information. It's just those sales numbers. And so let me then shift this back over to, this is looking at Costco. We'll go to financial statements and such. It's then combined all this into sales turnover net and such. So this is what I was talking about, that data standardized by S&P Capital, that you might actually have to look at some of those statements and such to see what's been standardized, what's been combined, to make it easier for tools such as our stock screener and such to kind of pull a lot of this information up for us to digest it. So back over here, we talked about the top line. We talked about operating income, that bottom line, that net income and such, dressing through. All this kind of comes down to earnings per share. Now, once we have things like earnings per share, if one company makes $10 a share, one company makes $1 a share, how can we then utilize that information? Well, if a company that makes $10 a share is trading at $1,000 a share, well, that's a 100 EPS, let's say a 100 PE ratio. Price 1,000 divided by earnings of 10, 100. Well, what if you're a company that's making $1 a share, but the stock's trading at $50? Now this has a ratio of 50 to 1. And as such, they're not priced as high compared to the earnings they're bringing in, so to speak. Or we can do this vice versa, where the higher price security is bringing in $100 a share. And it's only a 10 to 1, et cetera, et cetera, et cetera. So it lets us kind of compare one company to another with these ratios. Now, shifting over, cash flow and such. This is what a company is doing with their cash. Talk about receivables. It's what a company's owed, but hasn't received yet. Payables, what a company owes, but hasn't paid yet. Then depreciation, amortization, and such, where their machine's only good for 5 years. And as opposed to taking the expense all in year one, they're able to spread it out over 5 years and they got to replace the machine. Could be, other assets like buildings and such. Or, it might be, looking at amortizing other aspects and such with this, where values are changing from an accounting perspective that needs to then apply to their books and such. Depreciation, amortization is really a non-cash thing compared to actually receiving receivables, actually paying payables will impact the cash in the bank account, so to speak. That's kind of what we're looking at with cash flow here. Efficiency and such. You're able to do a lot of sales with very little assets. What does your inventory turnover look like? You only turning over your inventory once a year? You're turning over once a quarter, once a month, and such. How efficient are you with all these things? So much we could talk about. With that, though, anything you might want to add to the income statement, the balance sheet, cash flow statement, anything like that, Troy, before maybe we move on to a couple other concepts?
Yeah, I think, again, just with the limited time we have, again, financial statements are a huge part of fundamental analysis. They're not going to tell us everything, but it's going to help us understand more the company. It's going to say, all right, what's the company's capital structure? How is the company performed? When we're looking at the income statement and cash flow, I like to usually look at when we go to the financial statements, we can do quarterly, we can also do annually. And a lot of times you can see multi-year annual trends. And again, this is not going to be financial advice. This is not going to tell you invest in company, don't invest in that company, but it's going to give you contextually helpful information. For example, we know that Boeing's income and their profit and then their revenue has gone down substantially in a multi-year period. It's recovered somewhat. Now, if you look at the stock in a 1 year period, there's been some, other news stories in terms of quality assurance issues and things like that. So again, it's going to give you information that's going to be helpful when you're making an investment decision. Just with the time we have, Nick, I'll go ahead and just share the screen here. If we stick with Boeing, we could use Walmart and Target as you were kind of looking at here. But in addition to the financial statement info, again, we could take a deeper dive by going into more. Another area we can go is into key statistics. This can help us in terms of the valuation aspect, in terms of understanding, okay, what's the PE on the stock? What's the price to sales, the price to book, the price to cash flow? So we want to look at the valuation, understand, okay, here's the company, here's what it does, here's how much money it makes or perhaps doesn't make. Okay, what's the valuation? What am I paying for? And then in addition, I would say take a look at on your own time some of the additional information you have in these tabs. For example, the dividend and earnings tab tends to be very helpful. I would say if a company doesn't pay dividends, it's not going to really be helpful to look at the dividend info if a company doesn't pay dividends. And then if you're looking at the earnings aspect, I would say if you're looking at things like a valuation like PE, well, let's be honest, PE, how helpful is that to you if your company doesn't have positive earnings? It's not going to be super helpful. If you take PE and you divide it by a negative number, you're going to get a negative number. If your earnings are zero, well, as from a math person, I would say, let me save you some headache and don't go and divide a number by zero. Just don't do that. It's just a bad idea. But typically, if you have positive earnings, you're going to have a PE. You can come to this area and you can see, all right, well, Boeing's had negative earnings, gap earnings for quite some time. It doesn't have this PE history. But if you have a company that does, it's more mature, does have gap earnings, you can look at things like historical PE and say, okay, is the valuation high or low relative to its been in its history? And is its PE high or low compared to its industry? So again, it's helping the gears turn in terms of what am I paying and then what am I getting? So if the valuation's high, well, the valuation could stay high. Also, the valuation can be high and it could compress a little bit even with good company performance. So just make sure that you're not overpaying even for a great company, because if the company's really good, if the valuation's too high, it could take a long time before that growth could catch up to that valuation. Again, there's some pushback stylistically, right? Again, just bouncing off that concept that, Buffett and people like that might say, hey, I'd rather overpay for a great company than, get a good deal on a bad company. And I think that's probably a good concept to think about. In addition to the stock specific research info, and I'll come back to this, Nick. I know you want to maybe touch on the equity summary store and maybe the analyst info. I want to touch on a really good question that was posed by Gary here in the audience earlier on in terms of, hey, what are some things you guys look at? If I'm maybe a majority a chart-based trader or investor, what are some things I can look at? And, that's a great question. Here's the kind of the catch 22 with fundamental analysis. It's going to be the same with technical analysis in that there's no golden ticket, there's no magic ratio. It's a broad field, and there's a lot of things we can look at. For example, there's a really powerful tool called the Stock Screener tool. You can go to this and you can say, all right, we looked at the balance sheet, we looked at the income statement, we looked at the cash flow statement. Now, how do you want to use that information? And you can kind of think and apply it in different ways. Okay, maybe I want to invest or only trade in companies that have, for example, positive earnings. Maybe I want to invest in companies that have a certain revenue growth. So I want to invest in companies that are growing, and I'm going to use maybe revenue growth as a top line growth metric. Now, you have to also think about what's the trade-off too, because if you're going to, and I'm going to close this screen and just reopen it here. If you're going to sort out and filter only companies that have positive earnings, well, could you see some stocks that maybe have negative earnings that are starting to repair? You might be a little bit, see some of the performance on Boeing and say, well, Troy, maybe they repair themselves and maybe things are bad now, but maybe things get better. And that could be true. So you have to ask yourself, okay, what do I want to screen out and filter out? What am I looking for? And what could this tool tell me? Again, we could have we could look at earnings. You could look at certain valuation metrics. One of the reasons why valuation tends to be very closely looked at is if valuations are low, there tends to be a low bar. So the company doesn't have to do a whole lot to really kind of exceed expectations, so to speak. Now, usually, if there's a low bar set for a reason because people and analysts will think, oh, this company's done so bad, it's going to only get worse. And sometimes, even if it's not that bad, things might get better. So again, you might look at certain characteristics. So perhaps you want to look at return on equity. Maybe you want to look at things like debt to capital ratio in the most recent quarter or the last trailing 12-month total debt to equity. Hey, I want to look at only companies that have low debt. I don't want debt to be a thing that could be a concern for companies I trade. So you could then use some fundamental filters, and then you could say, all right, with fundamental filters, maybe I look at companies that have positive chart trends, or maybe I want to look at companies that are maybe trending negatively, but maybe they're at a support or resistance area. Maybe they have another characteristic like a momentum crossover oscillator event or something like that. So again, there's so many powerful tools, but there's no one size fits all. There's no quick and easy way to get amazing opportunities. You have to ask yourself, what type of investor are you, and how are you going to use these powerful tools to find opportunity? Again, there's different styles and there's different kind of thought processes in terms of saying, hey, a company that has low debt, well, there could be a company that has high debt and suddenly maybe sales start picking up. If even with if the chart rebounds and it does well, if a company has high debt and you set yourself a low debt filter, it's not going to fit your filter. So just make sure you use the filter to see what you want to see. Maybe you're saying, hey, I'm only going to look at companies with positive earnings. Again, Boeing's not going to fit your filter, doesn't have positive GAAP earnings. So just keep that in mind in terms of what are you filtering out and what are you going to see? What's the trade-off of what you're not going to see? And that could be helpful for you. Nick, I'll pass it back to you. I know you wanted to maybe take a look at either the equity summary score, or maybe you want to share some of your last minute thoughts in terms of some of the other data here we have on fidelity.com.
Sure. I do want to just spend, about a minute on the equity summary score. And then I'll share with everyone where they can find that recorded webinar I talked about beforehand. So with the equity summary score, if you come over here to some of these other fields, we're going to go to analyst ratings on here. A lot of people ask us, well, does Fidelity have a rating? And the answer is really not really. We're not like some of the other big full service firms. We are a discount brokerage and such that we're Goldman Sachs or Merrill Lynch might have a buy, sell, hold rating. But the closest we get is the equity summary score, and this is powered by StarMind. We've had it for quite a bit of time. What it does is it takes a lot of other firms' opinions. We have some relationships with some firms to be able to include their opinions, not with others, and it standardizes them. So as opposed to being a 1 to 5 stars, overweight, underweight, market weight, buy, sell, hold, it takes it just to a buy, overweight, neutral, underweight, sell. Or really, it's a outperform, neutral, underperform, sell on here. And after it standardizes that, it then gives it a relative accuracy score, based on how that firm's recommendations have done within that sector, that industry over the last quarter compared to what the sector industry has actually done. And the more accurate they are, the heavier the weighting. The less accurate they are, the lower the weighting. And it kind of combines all these into a score. Anything from 3 to 7 is considered to be neutral. So you have a lot more granularity because this goes from a 0.1 to 10. 7.1 to 9 is bullish. 9.1 to 10 is very bullish. So a score of 6.9, while technically neutral, leans very, very bullish side of neutral. 3.1, while technically neutral, leans on the bearish side of neutral and such. So you get a lot more of that granularity with as such. And many traders might use this as opposed to doing that digging into 10, 15, 20 different companies, to let the equity summary score do a lot of that work for them, so to speak. And this can, of course, be incorporated into our stock screeners. And so where you might be then screening for a company that's part of the S&P 500, or it has a specific market cap or not, and then has a specific equity summary score ranking that maybe you're comparing Costco here, again, with Walmart. What's Walmart's equity summary score? 3.4. So if you can only invest in one of them, well, you might lean towards Costco versus Walmart. But what if we kind of add in some other comparisons here? When we talked about recently has been Target with that. But we can come over here to the comparisons tab. As soon as this loads, we'll just skip over here like this. We're able to look at a comparisons on here. See, it should be under, we'll just click view all to view everything on here. We can scroll down, we can then see and look for comparative securities. Here we go, top competitors. Walmart, Costco on here with this. Doesn't quite have, looking to see if it might provide some others, but if we then shift over and, maybe we take a look at, as opposed to Walmart, as I said, we look at TGT for Target. Well, what's Target at? Because you only have the funds to invest in, one of these three or one of these four, one of these five companies here, and we see, as soon as this loads, we'll be able to see this 3.4. So Target versus Walmart, they're about the same, but Costco has a higher score with this, and so you might then look at allocating your capital to that versus the other. But still can answer, well, is now the time to change your allocation because trend and momentum might be something drastically different. With that, though, this really wraps up all the content that we wanted to cover, want to talk about today. But I'm going to come to the Learning Center here real quick. Just news and research, and then learn. From here, you can click on this search right here, or just what can help you find today, and then just type in fundamental analysis. Once we've searched for that, it's actually the second video up here. Let's talk about fundamentals. And on this, when we pull this up, we'll actually have a recorded video up here at the top, where you can download the slides down here. And this is the exact same slide deck that we used here today. And I think this is just me presenting this. I don't think I paired up with somebody, but I might have paired up with Jacob Ellis with this particular session. But this will also give you a recorded version of today's session. It's not going to be the exact same thing. We'll have a lot of similar information with that. That said, I want to thank everyone for joining us, for spending almost an hour and 10 minutes of your time with us today. Hopefully you found this to be a good and valuable use of your time, and we definitely look forward to seeing everyone in some of our future sessions. That said, we will be back soon. We'll be back in about 20 minutes for our Monday macro briefing. Albert will be here with Andrew for our Monday macro briefing. And then for those that want to kind of start to learn about technical analysis, we have a full week-long class on technical analysis, events, and then classes. And week one of our full week-long class on technical analysis actually starts at 2:30 Eastern time. And Troy and Chase will be hosting that class. And so come back for Troy. It's right here, fidelity.com/classrooms. Learn more and register for technical analysis. And you'll see this is every Monday at 2:30. You'll find this particular class. With that, though, thank you for joining us, everyone. Take care, and we look forward to seeing you in future classes.